Dominic, you're the managing director of Northmarq. You guys started those offices in 2021, and you grew them from 0 to 1.5 billion in sales.
One of the reasons why I wanted to get into the brokerage world, and you could apply this to anything, especially sales, but hard work will pay off. And what was really enticing about this industry was you're gonna get out what you put in.
Every year, there's less and less mom and pop owned apartment inventory in the US. Are you seeing that a lot of the deals that are trading are maybe going from the hands of either a mom and pop or a bigger regional player to a larger national player? Are you seeing that type of transition happen in our industry? Dominic, thanks for taking the time.
Thank you. I appreciate the invite here.
Yeah, I appreciate you making the trip to Fairview Heights, a trip that I'm sure you make often because you're all over the St. Louis region. You're the managing director of Northmarq, along with your partners, Parker Stewart and Alex Malzone. Did I say that right?
Correct.
And Alex is in the Chicago office. You and Parker are in the St. Louis office.
Correct.
You guys started those offices in 2021, a time that I think was very challenging. And it was brave of you guys to do that. And you grew them from 0 to 1.5 billion in sales, which is an incredible journey, but also just in a 3-year period to do that is absolutely amazing.
Well, appreciate the kind words. It didn't come easy, but it's also really team focused, and we're all rowing the boat in the same direction. And without that, there's no way that we could have had the success that we've had, and we're looking to continue that and continue to grow.
I haven't had the privilege of meeting Alex, but you and Parker are pretty young guys. Can you give me some background on how you got exposed to real estate, kind of your journey from maybe graduating to now?
Sure. So Parker and I have actually known each other since high school. So we were very good friends then, and we both went to Mizzou. I went to the accounting program there. I took the CPA. I started my career off at Price Waterhouse. Did that for a couple years. Parker started initially after college and went directly into commercial real estate brokerage. So being good friends, we would talk frequently. I was in accounting. He was in real estate. I knew accounting wasn't really what I wanted to continue to do, but it was a great background. If you knew the numbers in the business, it really was the platform that you needed to understand, and you could apply to any sort of business, any sort of industry. So it was a good base knowledge for me. Fast forward 2 years, Parker introduced me to one of my mentors in Kansas City when we were over at Berkadia. Made the introduction. I started there in 2018. Parker was in Chicago. I was in Kansas City. And from there, we weren't working together directly, but we were on a larger team. And we were actually the number one team over there. Come fast forward to 2021, or I guess late 2020, we got an opportunity from Northmarq, and it was from Trevor Koskovich. He was leading the charge in recruiting at Northmarq. So they had opened up their investment sales platform in 2018. They'd been around for 60 years with debt and equity. They said, hey, we're really looking to expand. We, Parker and I, are from St. Louis. We wanted to operate in St. Louis, and they came to us and said, we've got positions open. No one's here on the investment sales side in either Chicago or St. Louis. You guys seem like it'd be a great fit. Worked out perfectly. We were able to maintain our business strategy covering the Midwest with investment sales on multifamily apartments, and also focus on St. Louis specifically. So it worked out great, and it seems like we've just been heads down and working to continue to grow it as quickly and as really efficiently as possible.
So if I understand correctly, you're currently in growth mode and you're looking to grow the Northmarq presence in the Midwest as far as multifamily sales go, correct?
Correct.
So when you started in the business, I'm assuming you started cold calling and kind of doing all the work that some of the folks you were working with maybe didn't want to do anymore, or maybe they were doing higher leverage activities. Are you growing your team in a similar way? Are you bringing on people, training them, and having them kind of learn the Northmarq way?
Absolutely. In the sense of training, it's imperative. So we want to grow, but we want to make sure that we're doing it in the right way. It's really easy to grow too quickly. We don't want to do that. It's really easy to also not grow quick enough. We don't want to do that. So we're trying to find that middle ground to where when we do hire someone, they have the training that we are able to give them. We have the capacity to give that training, because if not, we don't want to set someone up for failure. But ultimately, once we get going, churning and burning, we want to continue to grow. We just opened up an office in Louisville with 2 other guys, and that they started in January of this year. So perfect example of our continued growth. But to your question on cold calling, yes, you start in the business, you're cold calling, it's a grind, you put your head down, you focus on one step at a time, one call at a time, and ultimately the money will come. It's just you have to focus on the day-to-day. And so we're teaching our new hires that as well, and making sure that they understand that this isn't a business that you get into and you immediately start seeing the rewards of your work. It takes a while, but as long as you have that mindset, it will come.
That makes sense. So generally speaking, and this depends on market conditions as well, would you say it takes 12 to 18 months for someone starting in the business to start to be able to pay their bills from the business?
I'd say that's a good benchmark, probably more the latter of the two. You're looking more 18 months, maybe 2 years until you really, fully grasp the industry. And you're still learning every day. So I take that back, not even fully grasp, but you're starting to get a handle on the lingo, how these investments work and how operations work, and just understanding a little bit more. Not only that, it takes 18 months to 2 years to really at least establish a name for yourself. So it's you don't see the fruits of your labor for 24 months, I'd say.
And you need to learn sales, but you also need to learn multifamily and then the markets that you're selling in or buying in. So for you guys, even though you're in St. Louis, Chicago, now Louisville, you're covering most of the Midwest, right?
Correct.
What markets are you covering? And then also, how do you go about educating yourself or your team on those markets?
So Northmarq's given us a ton of resources that has really allowed us to learn and understand each market. So we're in Missouri, Arkansas, Iowa, Illinois, Kansas, Nebraska, Wisconsin, all those states. And it's a lot to cover, but if you can work efficiently and know how to use your resources that are given to you, which without Northmarq, we would not be where we're at today by any means. They really provide us a ton of resources that allows us to succeed. And as long as you put in the time, you'll start to slowly understand. But it's not an overnight thing. You can't snap your fingers and learn a market. You have to study them as if you're studying for a final. But it's your career, so you really have to put in the time.
As far as the markets go, with you covering the Midwest, is it a similar story in each of the markets as far as what you're telling or educating potential buyers on, or does each individual MSA have its own story that you're telling folks?
It's a good question. It's kind of the flyover states. Obviously, there's going to be other MSAs that maybe stand out more so than others, but for the most part, in the Midwest, we're pretty steady. So we were talking to some other brokerage teams in some primary markets, transaction velocity down 70 to 80%. In the Midwest, on the other hand, our team specifically was down 40%, so about half of that. And I think that's a testament to just the steady, stable nature, It's really across the board: Des Moines, Omaha, St. Louis, suburban Chicago, all very similar fundamentals. And I think the biggest one, and really what we're seeing now more so than ever, is the fact that we really never saw that influx of supply, new development in multifamily come online. You look at Phoenix, you look at Dallas. I don't know how many units they've got. They've got 10 to 20,000 units going up. St. Louis has 3,500, to put in perspective. So you've got even Nashville, Austin, these major markets that have just seen such an overflow of supply when rates were really low. Construction was very prevalent in those markets, and now it's taking a while to absorb. So because of that, you're actually seeing negative rent growth in some of those markets, like Austin, Nashville, and that's really just due to the absorption that still has to be made within those new apartment units. Here in the Midwest, we've remained pretty steady. We haven't seen that supply really hurt our fundamentals just yet. So we've seen rent growth actually surpass the national average and other primary markets. So we've really remained pretty steady here across the Midwest.
I fully agree, and everything I read indicates that the Midwest is steady Eddie and continues to see rent growth when some other parts of the country don't. Mm-hmm. One thing that I try to tell people, and I'd love to get your opinion on this, is although we don't have the population growth in a lot of these Midwestern markets that you have in the Sun Belt or the Smile States, if you will, we don't have that new supply. So for developers, sometimes it might be easier to tell the story of, hey, we're going to Austin because they're seeing X population growth every single year, or we're going to Dallas, or whatever the case is. But if you're not looking at the supply as well, and will that population increase year over year remain the same, that can potentially be a riskier situation than a, quote, riskier market like a St. Louis. Would you agree with that, or do you have a differing opinion there?
Absolutely. And we run into that a lot when a lot of the developers, their equity is coming from institutional, semi-institutional platforms. Those platforms and those institutional companies really want to and need to check boxes before they invest, and population growth is one of them. So the markets like Dallas and Phoenix, they check a lot of boxes when it comes to population growth, rent growth, economics. Midwest is kind of the younger brother when it comes to those. We just remain pretty steady on population growth, but everything got overlooked, I think, back in 21 and 22 when the market was really good. Now that the market's slowing down and we do have this, I don't want to call it oversupply, but we've got a lot more supply in those primary markets than we do secondary markets. It's really allowing the Midwest to outshine some of those markets. So it seems safer. It seems like a safer bet. Hindsight's always 20/20. But I do agree completely that, look, you know what you're going to get here in the Midwest.
Do you find that a lot of the potential buyers that are from out of state don't fully understand some of these Midwest MSAs? Like if we look at St. Louis, for example, if you aren't in St. Louis and you pull 5 or 10 mile demographics or statistics on a Clayton, that might not tell you the true story of what Clayton really is. Do you find that, one, folks don't truly understand some of these markets if they're not from here or operating here, and then two, are some of the other markets you're in similar to St. Louis, or are they a little easier to understand?
The first question on is it harder if groups don't understand it, or if they don't know, do they understand it? St. Louis has a little bit of a stigma when it comes to selling new capital on the Midwest. So I just got off the phone with someone and was talking about how there are so many groups that are willing to go to Kansas City, but they're not willing to go to St. Louis. And when you ask the question, the response is always, it's not for us. There's no really substantiating reason, even though when you look on paper, the fundamentals are very similar. And because of this stigma, and whether it's driven by one little area, maybe it's downtown St. Louis, that just has this negative or gives off this negative perception to groups, it's an immediate no. But you talk to other groups that own 2,000 units here, non-local, they own here in St. Louis, they own in the Southeast. They'll tell you that St. Louis is one of their top performing markets. They own in St. Charles, they own in Maryland Heights, they own in the suburbs. And again, the fundamentals are really strong here, and they've continued to be. St. Louis has grown westward. 20 years ago, Wentzville was just a city you'd drive through to get to Columbia. Now there's apartments being built there. They're getting absorbed. There's rent growth. And St. Charles County is the fastest growing county in Missouri. So it really is easy to overlook a market like St. Louis. And to your question on, are other markets like that? It depends on the market, but yes, a perfect example of negative stigma is Illinois, the state of Illinois. Some people just don't want to touch it. They have this negative stigma that's maybe driven from Cook County, and they apply that to all the way down to Fairview Heights. You look at the fundamentals. I mean, you own in Fairview Heights, you own in Metro East St. Louis. You know as well as I do that the fundamentals are really strong, and you're not affected by that negative political, whatever you want to call it, from Cook County. So that's one, but then you look at maybe Des Moines or Omaha, they seem to get more interest. It checks a lot of boxes, and for that reason, you get a lot of competition. So I think it's a matter of just understanding and willing to look into that market.
I think perception definitely is reality in some cases. I've heard from someone that folks may go to a Kansas City instead of a St. Louis because they know if they lose on that investment, they're not going to lose their job. I don't know if that's true or not, and obviously it wouldn't apply to everyone, but I think that gives folks an edge who are willing to go to a St. Louis or go to parts of Illinois or some other markets. I'm sure, I don't think you guys are in Memphis, but I'm sure Memphis is pretty similar. They have a pretty negative reputation, but the suburbs are amazing.
Exactly.
Is there any particular reason, by the way, why you guys didn't go to Tennessee as well? It sounded like you mentioned every other state, but not.
So we have a Nashville office.
Okay.
And Nashville is growing so quickly that it's a full-time job. So Northmarq has a broker that focuses strictly on Tennessee, which is really the main reason. But the transaction velocity there compared to the Midwest overall is significantly higher. It's leaning more towards a primary market, in our opinion, over a secondary market, similar like St. Louis, Kansas City, Des Moines.
Got it. That makes sense. So speaking about a number of transactions, you mentioned a 40% decline year over year for you guys. What does that mean exactly? Like, can you give us the number of doors you sold in 21, 22, 23?
Sure. So 21, a little bit skewed because we just had come over. We had no support staff. We really had to work to hire that. Parker and I were sitting in the office until 3 a.m., 4 a.m., working on materials outside of brokerage, the day-to-day that we're doing now. So I'll fast forward to 2022 once we really became a little bit more established with our business. And in 22, and the market really shifted in April of 22, I'd say, with interest rates, but there were a lot of deals that were already committed. 22, we sold 26 deals across 6 states for 6,000 units. 23, we sold 4,000 units, totaling or between 14 deals and about $300 million. So, and a reason for that is interest rates. They spiked from the low 3s to upward of 6, and if depending on the lender, if you're going agency or bank or bridge, it could be anywhere in the upper single digits.
As far as interest rates go, what are you seeing in the market today with seller expectations, buyer expectations? Is there still a delta between the two? Is everyone coming to terms with interest rates? Or are folks expecting rates to be elevated for a longer period of time? Or just what's your general sense?
I think last year, people were much more optimistic that rates would come down. Beginning of last year, all we heard were rates were going to come down Q3 of 23. They've got to come down. Well, they didn't. And so now I think people are cautiously optimistic this year. okay, they're going to come down. I don't know if they're going to come down as much as what we had thought, but I think they've got to come down. So that's the consensus right now. In terms of the bid ask price, it depends on the asset. So that's another thing that we've really seen shift in 21 and even early 22. There was capital throwing money at multifamily. Inflation period, that was the craze that was post-COVID. Well, multifamily proved to be very resilient throughout that because, one, everyone needed a home. Well, if there's inflation, then rents will go up. And that's where we saw the 20% rent increase in Miami. That's where even St. Louis, we saw 8 to 10% in some of these Midwest markets. So you had a lot of capital chasing. And again, debt was very, very cheap. And you had multiple sources of debt. You had banks, you had bridge lenders who would lend on future values. And then you still had Fannie and Freddie who lend on in-place numbers. Well, when the rates changed and feds raised those in April of 22, the bridge lenders started to raise as well. The short-term 3-year money, floating rate debt shot up. And a lot of them pulled back from the market. The ones that were still there went from lending at 3 to 4% to now 12%. And it just didn't make sense to go bridge debt. So one fortunate thing that the multifamily industry has is Fannie and Freddie. But as they always have, they're lending on in-place numbers. So there's not that lender right now that's out there unless you have a relationship with the regional local bank.
And deposits.
That are lending on future values and upside. So because of that, you've seen this shift towards quality, stabilized assets across the Midwest. We're still selling assets all across A, B, and C classes, but I would say the buyer pool is completely different.
There definitely was in 21 and parts of 22 a convergence in cap rates between C class, B class, and A class apartments. Did you see a lot of people trade between the asset classes at that time? Like maybe sell a C asset, go buy an A or a B?
Absolutely. The lowest cap rate that we've ever seen was one here in St. Louis that we sold, 200 units, built in the 60s. It was a legitimate 2.6 cap rate. And cap rates are becoming more and more subjective. What expenses are you looking at? Is it the seller's trailing expenses, which are light or they're heavy? Or are you using yours? Are you adjusting for taxes? Are you adjusting for insurance? So they're becoming more subjective, but on a true cap rate, that was the lowest that I've seen. And that is when groups, one, were able to buy with debt that would provide liquidity based on future values. So yes, they were buying at a 2.67 cap rate, but they were pushing to a 7+ yield on cost. Well, when the debt's that cheap, nearly free in the low 3s, it makes a lot of sense. Now, when that lender is gone, and which here we are today, it's really just Fannie and Freddie. If you wanted that same deal, the loan proceeds would be much, much lower. So the cap rate's going to be more in the upper 5s, maybe 6 cap range.
At that time, like for someone to buy a 2.6 whatever cap deal, were they betting on or banking on market-driven rent growth or just their own rent growth through renovations or something along those lines? And then also, were they factoring in the inflation and expenses, whether it's insurance, repair materials, whatever the case may be?
Good question. So a lot of those here in the Midwest were bought because of the upside within the unit renovations. Okay. So not so much appreciation. You look at a Dallas or Phoenix, cap rates were so low there because of the competitive nature that you could either go to Fannie and Freddie, but the loan amount's going to be this. Well, if pricing keeps going like this because of, and I'm giving hand gestures, forgetting we're on a podcast, but if
we got the video. So.
So if pricing keeps increasing, the loan proceeds aren't. So then that forces a lot of buyers to go to a different direction. Well, that's when they would go to the bridge lenders, and the bridge lenders would lend as well on future values. And so a lot of the trades in the Dallas and Phoenixes were bought with bridge debt. The Midwest, we still had a lot of executions with Fannie and Freddie, unless they were value add purchases where they would go in, renovate, and push rents, not organically, but through renovations.
Got it. That makes sense. And I'm sure with the inflation you mentioned before, there were deals where they just didn't get a chance to bring rents to market, and future buyers could take advantage of that as well. Mm-hmm. What are you seeing today in terms of the business plan buyers are coming in with? Is there any popular business plan at this time? Like, for example, if we looked at the last 10 years, we're talking maybe buying C-class product, renovating it, like what we were just talking about. But is there any trend that you're seeing in the market today where you have a lot of buyers coming in and saying, hey, we're going to buy this deal because we could do X, Y, and Z, or we think X, Y, and Z is going to happen?
So I've seen this, what we call a flight to quality. So the groups that maybe used to buy 70s built assets, and I realized I didn't answer your question before on the expenses. Groups back then no one saw the inflationary period that we're still seeing when it comes to expenses. And definitely nobody saw, at least in our industry, the insurance increase. It's crazy how you talk to some owners that had $300 to $400 a door last year in insurance, and now in 2024, that's doubling to to 800 a door. So nobody saw that coming. And I think in the market that we were in 21, a lot of the risks get overlooked. It's, again, hindsight's always 20/20, and it's really easy to focus on the positives of multifamily. And again, we're still really strong fundamentally in this asset class. It's the debt that has just changed everything. So hopefully that answers your question.
Yeah. So it sounds like today most of your buyers are looking for quality. And a part of that is probably because your expenses are your expenses, whether your rent's $1,000 or $2,000. So that gives them a little more cushion to absorb some of those expenses. Would that be accurate to say?
Absolutely. And then one thing too that is causing this, now people are more cognizant of these expenses. Like I said, in an accelerating market, a lot of these issues get overlooked. The cost of repairs in older buildings get overlooked because you can focus. The focus is so much on the interiors and the upside and what they're able to do. Well, now, because there's no lender that's giving on credit for that upside, it's Fannie and Freddie, which is, again, we're very fortunate to have that. That's really funding 65 to 70% of these transactions. Groups are more cognizant and aware of the costs of these older buildings. And not only that, but the costs are much higher than they were 2 years ago. So because of that, groups have shifted that focus that historically were buying 60s, 70s built product to, well, now we're going to look at more 90s, early 2000s. We still want that upside. We still want the potential to increase rents based on renovations, but we're going to get away from some of that older product. Now, that's not everyone, but you do hear it a lot more frequently than you did back in 21.
Were there any big themes at NMHC? I think you attended. Were there any big themes just industry-wide coming out of there?
It's kind of funny. It's kind of like the game telephone. So people start to talk, they have a few meetings, and then it seems like the message is pretty consistent after that. Okay. And it seems like the message was there's very little inventory on market. We've got a lot of capital that we want to place. A lot of deals don't make sense. Going back to your question on the seller, buyer, bid, ask, there still is a gap because rates have just moved so quickly, and they're moving quicker than expectations. And that's not with every seller, but a lot of the times it's really hard to look and say, this asset was a 5 cap 12 months ago, I guess 18 months ago. Now it's a 6. It's tough to absorb that, and cap rates are moving just as interest rates move. But to your question on NMHC, it was a lot of capital still out there, but I think it's being patient. And a lot of it too is really I don't want to say hoping for distress, but watching for distressed assets, for those assets that were purchased with 3-year bridge money in primary markets. A lot of those deals that were bought, whether it was 80s, 90s, or early 2000s built, were bought with short-term debt. Now capital is on the sidelines waiting to see if anything comes available to purchase a quality asset in a primary market for less than what it was purchased for before.
That makes a lot of sense. I would imagine that with all the capital waiting on the sidelines, we may not see the type of distress that we thought we would. I feel like the longer it takes for the cracks to show in multifamily, I know they're showing in maybe some other product types, but in multifamily in particular, I feel like there's enough capital waiting to get into apartments that there may not be a significant downturn as far as valuations go. With that bid-ask spread, you're still generating a lot of offers on the deals you put out, because I get your emails and we talk here and there. Can you give us some insight into the number of offers you're generating today versus 2 years ago?
Sure. And to your point on the distress, I agree. And I think perception is reality. I think that is another theme that came towards the end of NMHC when brokers like myself were saying the same thing. I don't think we'll see the distress that a lot of people are expecting to see. And then towards the end of NMHC, people started to realize that too and thought, well, I don't know if we're really going to see it. Still being patient though. And going to your question on the number of offers, we're still seeing this. I don't think the number of offers has really changed that much. If it's a quality asset in a quality location, we're still seeing 20 to 30 offers on these deals. And what's interesting now is that it's a lot of new capital, qualified buyers that own really, maybe it's the same deal or the same profile deal in a different market. So we're seeing this new wave of buyers that are coming from Dallas, Atlanta, Southeast, Northeast. Groups that have never looked in the Midwest are now looking in the Midwest because of our strong and steady, stable fundamentals. So that's one thing that's different is the fact that it's new capital chasing these Midwest multifamily assets.
Do you find in a lot of these Midwest markets, the locals are not as aggressive as some of the out-of-state firms that come in?
I do, and I feel like that's just been the theme really ever since I started. And I think that a big reason for that is the rearview mirror outlook, where someone says, I saw what this traded for 5 years ago, or I know what I could have bought it for 5 years ago. It's tougher to pay top dollar when you know that, compared to someone coming in from Dallas who's never seen that and didn't know what it was 5 years ago. But the numbers pencil and they love the profile of the asset.
That makes a lot of sense. And I've seen that as well. That kind of reminds me of another thing that I'd love to pick your brain on. So every year, there's less and less mom and pop owned apartment inventory in the US. I don't know what that exact percentage is, but I know it's decreasing every single year. Are you seeing that a lot of the deals that are trading are maybe going from the hands of either a mom and pop or a bigger regional player to a larger national player? Are you seeing that type of transition happen in our industry?
100%. And it's probably one of the most attractive characteristics of an asset when we take it to the market is one that has been owned by a long-term owner, self-managed, that, again, perception is reality. So the perception to the marketplace is that it's underutilized in the operations. There's meat on the bone, there's upside, there's value add potential organically, as well as going in and upgrading the units. But most importantly, there's upside organically. So to answer your question, yes, there are a lot of groups chasing those types of assets.
And I don't think that's a trend that's going to stop anytime soon. Would you agree with that?
100%.
Do you see a lot of new entrants in the market that are kind of smaller mom and pops, or for the most part, are a lot of your buyers that are bidding on your deals these larger groups or more sophisticated groups?
It depends on the deal size. So we'll sell assets anywhere from $5 million to last year, our largest was $188 million. And so it really depends on the deal size. If you're in that 100 to 150 unit space, maybe $10 million deal, you're talking a $3 million equity check. That's different than a $20 million equity check. And the sources behind that equity are different, and the ways that that capital is raised are different. If you're talking $3 million, a lot of these high net worth individuals will be able to go to their high net worth friends and family and raise a few $1,000,000 and buy a $10 million deal fairly easily if they've had some experience doing so. Shift to a larger asset, $60 million deal, maybe it's a $20 million equity check. They're not going to friends and family to raise that for the most part. There's a lot of private family offices, wealth management, high net worth, whatever it may be, or semi-institutional capital that's funding this acquisition.
Do you find that the larger you go, the lower the return requirement?
I think that used to be, but because going to my statement earlier about there's a lot of patient capital out there, this isn't, I guess, a blanket statement, but when you're talking $20 million equity checks, that's semi-institutional, institutional capital, they're pretty sophisticated, and that's the capital that's sitting on the sidelines more than maybe the high net worth private individuals that can write a $500,000 check and still are very bullish on the fundamentals. It's the larger deals that they're tougher to raise the capital for right now. And it makes it, because of that, cap rates maybe not as low as a $10 million deal.
That makes sense. It's for everyone, but especially the larger groups. I'm sure it's a capital preservation play. And if you're not as sure of the fundamentals or just you think there's a little more risk than there was a few years ago, it makes sense that you'd have higher return requirements today.
Definitely. And also the fact that that's the capital that also wants to get into the primary markets. So that's where they're still waiting. Whereas maybe the private individuals here in the Midwest have always owned in the Midwest. It's been great. It's been the best performing assets in their portfolio. And they're going to continue to focus on the fundamentals. They've got the liquidity, whereas $60 million asset, it's the capital that is also able and wanting to go to the primary market. So just a little bit more patient. But I think in the other, let's say in 2021, you'd have a lot of competition with capital throwing money at these larger assets.
That makes sense. So if we had somebody leaving a primary market wanting to come to the Midwest, it all comes down to the deal, the submarket. But ignoring all of that, if they said, guide us to any city that you cover, where would you take them? Only one city.
I can't choose a city. So this is a biased answer, but I do think St. Louis gets overlooked. It goes back to what we initially talked about. There's a stigma, and I just talked to someone today about it. Kansas City seems to have lower cap rates. And I think because of that stigma, it's crazy how this industry is. There's so much perception that drives decision making. And because of the perception of St. Louis, I think a lot of groups won't go here, but the ones that do very well. And you look at Kansas City, you look at Indianapolis, Columbus. Everyone knows those are hot markets. Everyone wants to be in those markets. I can't say the same for St. Louis. So for the ones that do, I think they're going to get very strong performing assets at a discounted price relative to the highly sought after Columbus, Kansas City, Indianapolis. I also think the tertiary markets get overlooked a lot. We talk about how we hadn't seen the development in the St. Louis, Des Moines, Omaha. Well, imagine the Columbia, Missouri's Springfield, tertiary Illinois. There was very little development there. At one point in Q4 of last year, I want to say 4 Midwest tertiary markets were in the top 10 within rent growth, because while everywhere else was filling up these apartment units that had just been built, and there's a trickle-down effect from the primary markets to the secondary markets to the tertiary markets, these markets still remain very strong. Occupancy is still 98% in Columbia, Missouri. It's still 96% in Springfield, Missouri. While St. Louis had a 3% rent growth, Columbia had 7%. So it was a little behind, but mortgage rates are still the same in those markets. And it's not easier to buy a home there than St. Louis. So in theory, your renter class and your demand is going to be the same, but there's less supply. So we've been seeing really, really strong fundamentals in these tertiary Midwest markets that hadn't seen the supply come online.
So let's say this hypothetical group says the tertiary market's too small. They want to come to St. Louis. If they want to buy Class A or B product in a Class A or B area, what can they expect in terms of maybe price per unit, cap rate, things like that today?
I'd say price per unit's a byproduct of the rents. So it really just depends on where your rent's at. Are they?
Let's start there. Like, let's say they're looking for Class A product. Mm-hmm. What are we typically looking at per square foot in St. Louis?
It depends on the area. If you're looking in Clayton, you're going to get north of $3 a square foot. If you're going out to Chesterfield, you're upper 2s, maybe 3s. St. Charles, maybe $240 a square foot.
So if we pick Chesterfield in that example, what are we potentially thinking? Cap rate, per square foot, acquisition cost?
Class A.
Yeah.
So, and the reason why I ask is because typically the Class A has, it's more of a coupon clipper. Mm-hmm. There's not that value add potential. So what you're getting into is relatively going to be what you're getting out of it.
And the reason why I said Class A as well is because if we start to say Class B, it becomes subjective, like we talked about earlier with the expenses, what you're going to do, maybe your game plan. Let's just say Class A product.
Yeah, agreed. It's a good benchmark for where cap rates are. 570. So today, I'd say 575. It depends on where interest rates are. And that's really been driving cap rates too. I remember when rates were starting to move in 2022, people were optimistically thinking that because cap rates and interest rates historically weren't directly correlated, that they wouldn't move. Well, they did. And again, that's because of Fannie and Freddie really being the main provider for the liquidity on these acquisitions, 65 to 70%. We're talking, if what they say goes, then that's where the cap rates will relatively be. So if we're talking a 6% interest rate, nobody wants negative leverage. We're hearing that term more than ever. We started hearing that term more than ever last year. But it seems like there's always a few groups that are willing to go in with negative leverage, meaning a cap rate lower than the borrowing rate, with the idea that because of rent growth and because of the organic fundamentals that we have here, by the time that they exit, their cap rate is going to be above that borrowing rate. And overall, they're looking at a 5-year hold and saying, what are my cash returns? Do I hit my hurdles? So today I would say 575, give or take. It could be 5.5. It could be 6, but it's really just a matter of where the rates are.
And if the rents are, let's say, 2.25 a square foot, and let's call it this hypothetical property's 1,000 square feet a unit, 100 units. Mm-hmm. What are we looking at approximately per door?
So those are bigger units. So that's, you're saying 2250. Yeah.
There's probably no Class A product that's 1,000 square foot.
It's almost townhome product at that point. This,
I was trying to make it easy on you, but we can go with something else.
I know. Yeah, the math. No, you'd be looking north of 300 a door.
Okay.
Easily. I think if there's a 1,500 a door, you'll be at maybe 1,500 a door in rents. Maybe 225,000 on per unit on a sale.
Okay. So generally speaking, if you're buying Class A product in St. Louis today, and you're buying at, call it between a 5.5 to a 6 cap, you're going to be paying $250 to $350 a square foot, probably.
That's about right. Yeah.
That's still very reasonable compared to any of those primary markets that we were alluding to before.
No doubt.
And these submarkets where you're going to find the Class A product are, I think, like, you can't beat them. But I'm sure other people may have other opinions, but they're great places.
100%. They have really strong fundamentals. And I think right now there's a lot of groups nobody wants to make a mistake in a volatile market, but it's good to see that with all of our transactions, it seems to be very credible groups at the top every time. I don't want to call it dumb money, but there's just not that dumb money out there right now. It's very sophisticated capital that's chasing strong fundamentals across the Midwest and blocking out the noise that maybe a lot of the skeptics are saying and hearing. So you stick to the fundamentals. The assets are showing that they're performing really well in the Midwest, and I think overall the investments are going to be really strong investments. And we've even heard that over the next 18 months, people may look back and think that now was the time to buy. Who knows? But it's interesting to hear, and I don't know. I feel like anytime someone guesses, it's probably going the other way, but hopefully that's the case, and it's just a little blip in the transaction velocity that we're in right now.
Yeah, I would agree. I've heard the same. I've heard from some folks that it could be time to buy now, and the 2030s when we may actually have, the big recession or downturn. There's a group called ITR Economics, I think is what they're called, and they had a similar theory. So as you know, Storyboard, my company, is kind of patiently waiting for the right opportunities. How many storyboards would you guess there are in the Midwest? I think there's got to be thousands, but what's your guess in terms of, we know there's lots of capital on the side, but how many potential buyers are there if we see a distressed deal? Like, let's say we start to see distress tomorrow. And there's a 30% decline in where we are in terms of pricing today. Would you expect to start seeing hundreds of offers on a deal, or what would your expectation be?
I don't know if we'd see hundreds. I think it's who's going to have the capital to execute on it. Because if it's distressed, Fannie Mae and Freddie Mac, they don't lend on. They've got to be agency financeable, so they're not going to lend on an asset that's less than 90% occupied. So if it's distressed, it's most likely we're talking in distressed operations.
So then you need bridge, bank, or cash.
Exactly.
Correct?
So then it becomes, you filter out all the buyers that would love this. Now let's take out the ones that don't have that access to liquidity. So now it's, are you buying cash? Are you buying bank? Are you buying bridge? And out of all the 14 deals we sold last year, only one was a non-agency execution, and that was a 65% occupied asset. The buyer had to finance the acquisition with regional bank debt. And that buyer was one of few that had a strong enough relationship with a bank that allowed him to acquire that asset. There are groups that maybe 2 years ago had relationships, but because of the deposits that they have, or maybe that bank just isn't lending right now, that buyer can't execute on that acquisition. So again, the access to liquidity is no longer there. So I don't know if we're going to see a massive stampede of buyers going to these assets. I think it's going to be the ones that have the access to that liquidity.
And going back to the perception piece we keep touching on, there's also, if that happens, there's going to be the perception that maybe there's going to be further declines, and maybe you won't see people jump in right away.
That's a good point too. That going to the point of nobody wants to make a mistake.
Yeah.
Do they think that it's getting worse, or do they go now? And nobody knows, obviously, but I think that's a great point on even if they do see something, are they going to be extremely aggressive towards it or be still cautious?
I guess we'll have to wait and find out.
Hopefully we don't get there, but
I hope we don't. I think we will see some sort of bumps in the road. I don't think it'll just be smooth sailing from here on out, but I think we won't see that level of distress. We like to end each show. We've been speaking for about an hour now, so I want to be respectful of your time. We like to end each show with what we call a hole-in-one. It's your biggest piece of advice for anyone that they can apply today in either business or their personal life. Do you have a hole-in-one you can share with us?
I think it's going to sound cliche, but one of the reasons why I wanted to get into the brokerage world, and you could apply this to anything, especially sales, but hard work will pay off. And what was really enticing about this industry was you're going to get out what you put in. And it's a really competitive business. If you are willing to put in the hard work in whatever you do, there's going to be positive outcomes of it. And I think if you apply that methodology to anything, you're going to see success. It may not be overnight, but keep your head down and keep working, and the fruits of your labor will come.
And wake up early, right?
Wake up early. Exactly.
Where can people reach out to you, Parker, Alex, or just anyone at Northmarq?
So we've got a Northmarq website, Northmarq St. Louis. It's got all of our contact information, Northmarq Chicago. And reach out. And even if it's just poking us to see what's going on in the market and what our thoughts are, please don't hesitate, and we're happy to be a resource. Aside
from buyers, sellers, can potential folks who maybe want to be in the brokerage business reach out to you as well?
Absolutely. Yeah, like I said, we're always trying to grow. We want to grow in the right way to where it's the new hire has our full attention. And so we're always open for ears. But yeah, we want to continue this growth and want to make sure we're doing it the right way.
Awesome. I'm sure the growth will continue. Thanks so much for your time.
Thank you. It's good talking to you.
Yeah.